Welcome, everyone. So glad you're able to join us for HDL's latest California sales tax trends and forecast webinar. All right, as I made mention by way of introduction, I'm Bobby Young, Client Services Director here at HDL California Sales Tax. I'm joined today by Brett Plumley and Susie Woodstock, fellow principals who reach out and meet with clients on a quarterly basis, bringing you all good information and keeping you up to speed on the local trends that are happening within your jurisdiction. Along with the rest of our team, this is what we enjoy doing, and bringing you good sales tax information. Real quick about HDL, most of you already know, but we've been here in California for 40 years, over 40 years. We are blessed to be 100% employee owned, which helps us bring tangible services directly to you. Nationwide, though, we serve over 800 municipal clients with a very strong, and we are blessed and thankful to have a 99% plus client retention rate. So thankful to have you as clients and keeping you on board. And again, giving you good information. Let's jump right in. We're talking about 2Q or second quarter 2024 sales tax results today. Second quarter, as a reminder, April, May, June time period, right there at the beginning of the summer months. We had some high hopes leading into, especially coming off of a first quarter to January, February, March, which really changed the tone a little bit from calendar year 2023. Calendar year 23, as we've seen through graphs, and we've talked a lot about, down compared to that post-COVID or post-pandemic boom that we experienced. First quarter, we flattened out, and we had some really high hopes for what the summer would be. And as you can see on the screen here, where we ended up, flat again. I wouldn't necessarily say it popped our bubble, but it definitely was like, oh man, we were hoping for a little bit more. And then when we really kind of think through, well, what didn't happen? You can see here, very similar to the first quarter, autos, transportation, building, construction, which Brett will be talking about, and general consumer goods, which is what Susie will be talking about later. All three of these major categories down here for the second quarter. Probably not unexpected, especially out of autos and transportation. A lot of what I'll be talking about this morning, interest rates and how it's impacting, but that also trickles over into building construction and home loans and accessibility to equity that homeowners have built up. Just not there, not yet, if you will, when it comes to forecasting. But here 2Q, oh man, tough to see it. It's kind of that stagnation, a little bit of lackluster results. And then when you actually, the one kind of lone bright spot or helping prop it up, the county pools, countywide use tax pools, growing at 3.6%. So it's not as if altogether consumers pulled back and stopped spending. That's definitely not happened here within California, but it has absolutely slowed on some of those bigger ticket items. Again, this is a lot of what we've been talking about over the last few quarters, where consumers are putting their money. The pools, online goods, think value a little bit lower priced comparatively speaking. So we did see that gains out of the pools, which again kind of helps offset. To the right on the screen, you can see it doesn't really matter where we were in the state, where you were in the state, the year over year 2Q results pretty flat, plus minus in different areas, but just kind of stagnating through. Some of the considerations as the team and I sat around, I think this time we ended up sitting around for almost 7 hours talking about 2Q results and figuring out what was going to be happening going forward. You can see on the screen all the way to the left, one of the bigger topics, most notably interest rates and the effect that either has or hasn't had on consumer credit and availability to access funds and really then increase spending. Consumer spending and costs altogether, CPI, cost of goods, a little bit more expensive. Okay, what is that having? What play is that having on consumers? Gas prices, not necessarily as high during the 2Q and coming 3Q period, which probably left a little bit of room for folks to spend on travel, which is more on the good side of the overall spending economy as we evaluated it. But these were three total 6 major considerations that we spoke about when analyzing each individual category. Interest rates. So diving in, just last week, Feds take a big step. Fed Treasury takes a big step in dropping the Fed funds rate 50 basis points, 0.5% overall. On the screen here to the left, you can see just a reminder of what had transpired post-pandemic and dramatic increase at the rates. The period in between the top line there, the rate reduction that we just experienced, and the last rate increase, that period there, probably, as most of us would sit back and think about the economy, probably went on for a little too long. Would have hoped that the Feds would have reduced rates a little sooner. If you go back on previous webinars, I definitely sat here and said, hey, we'd love to see a rate reduction to be able to inspire consumer confidence and increase spending. Didn't happen all throughout the first part of 2024. So now here we are with what most would acclaim as a dramatic decrease in the Fed funds rate. And coming up on the next meeting, which is in the early November, we've got some, kind of otherwise financial analysts or finance professionals calling for another dramatic 50 basis point reduction. Again, trying to hope that it inspires confidence and inspires consumer spending, really start growing the economy again. I would say that's very optimistic, given what we've seen at the Fed Treasury most recently. I'd say it's maybe a little too optimistic. 0.25% come November would be great. You'll see how we factor this into our overall forecast, given that here we are coming up living at the beginning of the 2024-25 fiscal year, right? And what that's going to be causing. But interest rates were most certainly a big part of our conversation, and especially as tangible it is for us as consumers. California unemployment, and this is just a quick slide here, noting that as you look at the far right, and definitely let me throw a little pointer on it, right over here, you can see unemployment otherwise has inched up. It's one of the markers that the Fed Treasury is continuing to look at to kind of monitor how much they would like to try to help the economy along on the Fed funds rate, given that if they continue to see unemployment go up, it may inspire them to decrease Fed funds rate a little bit more. So keeping an eye on it overall. Income versus spending, really here most notably is the far right. You can see the red line is on personal consumption overall, outpacing overall personal income, right? And so here we go. Yep, we've been in this tight environment. Folks are continuing, I think on the next slide here, savings and disposable income. You can see overall personal savings rate continuing to decline. We've been highlighting this just as we, again, think about consumers. This is on a national basis, but we obviously can easily translate it into California. But with a decrease in the savings rate, folks are getting to that kind of point of making very, very difficult decisions on where they're going to spend their money. And again, that all comes back to kind of our flat to stagnated year-over-year change on sales tax overall. Goods and services, what's driving CPI? And herein, just most recently, the kind of more reddish orange is CPI related to specifically goods versus the blue, which are services. So services and increased cost of services has remained fairly steady. It's been more on the goods side that have dropped. Retailers looking to offload a lot more merchandise, reducing pricing, good for consumers. But again, we as consumers are overall balancing where are we going to spend our money. So this is helping on the CPI factor overall and inflation, as it were, but it probably still has a little bit more ways to go. And credit card spending. Here, just relative to the inclusion or exclusion of restaurants, which Susie will be talking about later here in the presentation. The blue the blue excludes restaurants, and you can see throughout 2024 how kind of flat to a little bit down year over year, how that's changed. But once we do include restaurants and that thirst to be able to eat out and dine out, you can see how much that continues to increase year over year for consumers and using credit to buy goods. again, kind of a final point here for us as consumers, when we again look at the bigger picture, we can't avoid or don't kind of leave out the overall cost, household cost, which include most recently here in 2024. I think it's been a banner uh, headline year, if you will, for home insurance, car insurance. They're included, and the dramatic increase in price for us as consumers, and how that then continues to tighten the overall household budget. You can see how much full coverage home insurance has continued to increase here within. Actually, this is on a national basis again, but specifically for California, we've got some headline points here. Really tightening the pocketbook for California consumers. Putting all that together, looking at, well, gosh, it would have been great to have lower interest rates helping us kind of manage all these increased costs, is really what kind of doesn't give us a lot of hope for what's to come in the most recent, or specifically in the short term future that we're looking at. 2Q is also the end of the fiscal year for most here in California, running from July to June for your fiscal year reports. You can see pretty much statewide, the majority of results were kind of in that plus or minus, 4% either way, right? In between that, not dramatic year over year. And even to the yellow and orange that you see here on the map, most saw really that decline, slowdown from fiscal year 22-23. A lot of what we've been talking about, obviously, throughout the most recent results, as we wrap up the fiscal year, you see down 1.3% for 22-23. Here's the period coming up, which I made mention. We're not expecting overly dramatic gains when it comes to sales tax and the feds, and they're kind of that slow timeliness to really reduce rates and get us going again. That's going to trickle over, or at least likely impact, the entire fiscal year. 24-25 is where we sit right now. Not expecting a return to normal growth now until fiscal year 25-26, when it really has time to kick in. Probably next summer is when we might expect things like building construction and autos, which Brett will be talking about, to help really boost along the spending economy. So this is a quick glimpse of what we're thinking. I think I'm going to turn it over now to Brett.
Hey, thank you, Bobby. We're going to talk in more detail now on the various major industry groups, starting here with autos and transportation. And as Bobby indicated, this particular sector was hit the hardest in this quarter, as expected. The actual results really close to what we had forecast, down a little bit more than 6% in this quarter. We are on the positive side when we look at the trends here. On the green, upward pressure and sales tax, we are anticipating a buyer's market coming forward as we head into the future. We're starting to see more dealer incentives that are out there, and we are anticipating that consumers will shift to start purchasing more vehicles. This green here, the luxury route that may be close to ending, we are anticipating that luxury segment that's been hit 6 quarters in a row now with declines. Hopefully that will be coming to an end as we move forward. On the neutral side here, smaller, we just wanted to indicate that consumers are starting to switch over to purchasing smaller vehicles again. They're more affordable. With the big increase in prices, it's been more difficult to buy the larger vehicles. The record age of vehicle we've been talking about for some period of time now continues to grow, now at 12.6 years on average, and that will likely be changing as we move forward into the future here, as consumers shift, get rid of their used vehicles, start buying new vehicles again for the comfort and ability to have a better car, better quality car. The interest rate impacts that Bobby's been talking about, the 0.5% decrease last week, we're anticipating in many of our major industry groups, you'll see that in the forecast, early 25 will begin the impact, kind of a delayed reaction somewhat to the drop. And as Bobby mentioned, also depending on if there are additional decreases before the end of the calendar year. On the red side, the big factor has continued to be the prices dropping, and that is having the biggest negative pressure on sales tax overall in this sector. Some quick facts here. That cyber attack we talked about last quarter, it did cause disruption in the automotive industry. 15,000 dealerships were impacted. It negatively impacted the reporting and inventory levels continuing at this point. And new car average transaction prices, they're a little bit lower than the market peak in December 22, but still those average prices and the transactions remain 13% higher than July 21. Prices were skyrocketing at that time, as you remember, during the pandemic times. And then as we talk about buyers market potentially coming forward here, we are seeing more incentives. Manufacturer incentive increased to about $3,400 in July. This chart showing new vehicle pricing, you can see it was fairly stable for a long period of time, 2015, all the way through the beginning of the pandemic on into calendar year 20, and then that really steep increase post-pandemic, which continued all the way into early 23. It's now flattened out and starting to come down. So hopefully that will have a positive impact on this sector as we have projected in the short term and going out a little farther into future fiscal years. This one, Bobby mentioned the impediments that have been placed on, in this particularly impacting vehicle purchases, the credit availability index. It's now dropped down to the most restrictive that it has been, down below 100 since 2020. And here are the segments we've been reviewing for the past several quarters. The luxury vehicles, such as Mercedes-Benz, BMW, Jaguar, we've seen 6 consecutive quarters now of declines, and effectively the past 4 quarters, double digits. So we are hopeful that that will come to an end. That will start to cause a positive impact as luxury vehicle purchases start to pick back up again. The value vehicles there, such as we have the Toyota, Honda, Kia types of vehicles in that category, and we've had a number of periods consecutively with increases, and this is kind of the opposite impact right here. In this particular quarter, that value type of vehicle was down. So hopefully that's not going to offset what we're hoping is a recovery in the luxury vehicle types of purchases. Domestic vehicles have been down the past couple of quarters and now have flattened out. So that should be upward pressure as well as we move forward into future quarters. Here's the overall forecast, and second quarter, we've been talking about down a little bit more than 6%, very consistent with what we had projected. We've taken 24-25 fiscal year down. We had that about a 0.5% increase. Now we're down about -0.4. You can see first quarter 25 beginning to recover 1.5% and then 2.5%. So we're at 24-25 fiscal year down 0.4%, and then recovery beginning in 25-26, 3.5%. And this is consistent with what we had projected last quarter. We have about 4% growth in those out years going all the way out to 29-30 at this point. Now we're going to talk about the fuel and service station sector. And the story primarily is downward pressure of prices. You can see a lot of red in the trends here, and most of it is attributable in terms of the impact on our forecast to the third quarter. Third quarter down very significantly. Okay, this particular chart here is showing the past several quarters, comparing. When we look at the first quarter 24 was actually up a little bit in comparison to the first quarter 23. Second quarter was up a little bit more, about 6%. And then the decline that you see third quarter 24 is down about 12% compared to third quarter 23. And that is really what's having the biggest impact on our forecast the remainder of this calendar year. Okay, so this one we talk about April and May consumption continues to be down. Now, this is the latest figure that we have, and 5 months of 24 are actually down in comparison to the same period in 23. Calendar year 23, we talked about last quarter, was down in total motor vehicle gallons of consumption compared to 22. So downward pressure on sales tax. Okay, so overall here now, we have, if you look at, we've highlighted second quarter 24 positive results, 1.2, but not as positive as what we had forecast. We had projected about a 6.5% increase. This one also is an outlier. We have experienced 5 quarters in a row before this of negatives, and so it's a blip upward, which is good. Third quarter and fourth quarter of 24, then that is the most significantly impacted period of time, down 10% the next 2 quarters. And that's taking our overall forecast for 24-25 down to about -4%. We had projected a 1% increase last quarter. So that's a pretty significant 5% swing downward for that fiscal year. When you look at first quarter of 25, we start to see recovery consistent with that tie-in to the Federal Reserve dropping the interest rates. And then we're projecting continued ongoing 2% growth, pretty normal growth all the way out to 29-30. Here, now we're going to talk about building and construction. And this is the chart on the trends, the positives in green, upward pressure on sales tax. And lumber prices are on the rise. They're still a little bit lower than they were in the third quarter 23, but helping to solidify this particular sector in this quarter. Roof repairs, cement plants doing pretty well in this quarter. Infrastructure projects have been launching the past several quarters. That was kind of a delayed effect, but now finally kicking in and having a positive impact on the overall group. And on the negative side, the big home improvement stores down again this quarter. Housing development, Bobby mentioned, housing has been slow with the mortgage rates up pretty significantly. They're now starting to drop. Refinancing is already starting to pick up. So we are hopeful and anticipating in our forecast that to have a positive impact early 25. The rooftop solar residential permits have pretty much dried up as those incentives went away about a year ago. Lumber prices here all over the board. We've shown you this the past several quarters, but the good news is over on the right, an increase, a blip upward on prices, and that is going to have a stabilizing effect on the overall sector. Here's ready mix. We talk about this particular type of purchase, very solid. You can see steady growth going all the way back to 2020. Pretty steep incline over a period of time. The most recent quarter up a little more than 6%. Very solid. And the overall forecast at this point, second quarter 24 down 2.5. It's a little bit worse. Bobby had highlighted this at the beginning of it. One of the sectors that was hit harder. We had projected a decline, but 2.5 overall drop. And then 24-25 fiscal year, very flat, consistent with the story overall. And we have now, we've kept it at -0.5%. Look at first quarter 25 there. We highlighted that once again, consistent. We've got a boost starting, anticipating with the increase in the overall economy happening early 25, and then very solid 4% growth 25, 26, and 4 to 5% as we move out into the future. And now food and drugs, cannabis. We've talked a lot about this consistent story, been dropping down significantly for a period of time now. The most recent quarter results down more than 10% again. This peaked back in 2021 post-pandemic, but really clearly this particular type of purchase, this industry has saturated and has flattened out. Overall forecast, second quarter 24 down about 2%, which we had projected flat. So we've taken down 24-25 fiscal year to about -0.6%. Grocery store sales continue to make up about half of the group, and they were up almost 2% this quarter, helped to flatten out the results. Most of the other business types were down. Convenience stores and liquor stores make up about a quarter of the group, down 1%. Drug stores with those closures, Rite Aid down almost 11%, and cannabis. So mixed results. We've taken our forecast down a little bit, 25, 26, 1.5%, and then 2% growth all the way out. And now Susie.
I'm going to start with this illustration because I'm going to talk about 4 major industry groups, and 3 of those groups have parts of general consumer goods. So before I jump into those major industry groups, I have this illustration to compare what goes where. First, we have brick and mortar stores. Those are direct allocations to the agency where the store is located. And major industry group general consumer goods is 100% of these brick and mortar stores. This is the over-the-counter transactions. Next, we have the online merchandise that comes from out of state. If merchandise is not located in California at the time of order, it will be distributed through the countywide pool, which is an indirect allocation method. About 59% of online transactions are distributed through the pool. And lastly, we have the online that comes from in-state. In general, this will be allocated to the agency where the fulfillment center is located and will show up in the business and industry group. About 41% of online sales are allocated to California fulfillment center locations. The line graph on the side shows brick and mortar in the green line and online in the blue. They've been trending differently for a while. Besides a brief bump positive in 1Q24, brick and mortar have posted declines for several quarters, while the blue line, online shopping, has been positive as it was up a little over 4% here in 2Q24. Now jumping into those major industry groups. General consumer goods, which we are all on the same page, is the brick and mortar stores. 2Q24 looked a lot more like the results that we experienced throughout much of those recent quarters, reversing some of that more optimistic performance that we had in 1Q24. Looking at first half of the calendar year combined, the segment contracted about 1.2%. On this graph, the only positive of the top categories is discount department stores, with family apparel posting flat. Looking at the CPIs for some of the common categories found throughout general consumer goods retailers, we see many categories have experienced deflation, even though inflation remains positive. Without significant increase in demand, lower prices are going to translate into lower tax receipts, which is one factor contributing to the soft performance in the brick and mortar group. Many retailers provide forward-looking guidance, which provide insight into how they anticipate short-term performance. Here we see off-price apparel remains strong in both earnings and sales tax. Ross and TJ Maxx both have positive outlooks. Department stores continue to expect diminished sales. You see down here Macy's and Kohl's, and Best Buy in the electronics group. The beauty segment appears to be slowing. We've got Ulta here right in the flat group. And then discount department stores continue to expect positive results driven by the value and the convenience, as well as health and wellness categories, with Target, Costco, and Walmart in that discount department store with positive retailer guidance. So overall, looking at the top gray box here, we see 1Q gave us that glimmer of positivity, but then we're down about 2.4%. Again, as Bobby mentioned, this is one of the categories that brought our overall outlook down. We had projected, hoping that the 1Q was the turning point, that 2Q would come in about up 1%, but it ended up down about 2.4%, with the fiscal year ending down about 2.2%. With that slowing, we have slowed down our third and fourth projection, looking at down about 0.6% for next year, not really looking at positive results until 25-26. Now we'll move over to the pools. This is the group with a portion of the online general consumer goods. But as you can see, the pool also has other categories. As you know, the pool is mainly items that are coming from out of state. The two biggest categories in the pool were up, both the general consumer goods and business and industry. While just like the direct allocation, building and construction did see a slight decline. Autos and transportation is a lot of private to private sales. And so it doesn't follow the same trends as those dealerships in the direct allocation major industry group. It was actually up 8.2%, really helping to contribute to that 3.6% growth that we saw in the overall county pools. The county pool trend here, this is comparing general consumer goods to all other major industry groups in the pool. Back in 2019 and 2020, we had AB 147 that was adding new revenue. So general consumer goods that were shipped from out of state were required to start reporting, and that really boosted the general consumer goods category. And you see that big growth back then. But now we're starting to hone in, and both all the other major industry groups and general consumer goods are getting back to kind of a similar growth pattern here. Overall, with that, looking at our pool forecast, again, came in strong and in second quarter at 3.6%. Now we're looking forward at growing at about 2 to 3% for the outlook quarters. Overall, fiscal year came in down 1%, expecting it to go back up to about a 2.5% growth for next year. Okay, the next major industry group is business and industry. This is a big eclectic group, but the biggest slice is now those in-state fulfillment centers, which are about 27% of the business and industry group. As mentioned earlier, we've had some shifts in reporting from out of state to in-state. The direct allocations here show up from in-state fulfillment centers. The large growth, again, back here, these big gray bars, that was AB 147. Here it brought in new revenue from the marketplace facilitators and, of course, the online pandemic behavior. We'll move on from talking about the general consumer goods portion. And like I said, business and industry is a big eclectic group. Other categories include medical biotech, electrical equipment, heavy and light industry, agriculture, energy, wineries, the motion picture industry. It is a big collection. The top business types are shown here. These are about 51% of the business and industry group. These 10 sectors have averaged about a 2.8% increase in second quarter 24. You can see, though, there's a lot of red on this slide. Most of what is contributing to that big growth is the energy sector, also backed up a little bit by electrical equipment, which is associated with the energy sector. Both of these sectors experience peak with installations of large energy projects. So it is not a consistent, ongoing type of growth. Looking at some of the considerations for the business and industry forecasts. Of course, the projected growth for fulfillment centers will play a big part in the forecast, since 27% of this group of business and industry is the fulfillment centers. We're anticipating about 4 to 5% growth moving forward. Again, we had about 6.5% growth in this sector in this second quarter. The other thing we watch is the ISM for the manufacturing input. It relates to our light and heavy industry business types, which are the third and fourth biggest sectors in the business and industry group. The index is still contracting. High interest rates were hurting investments, but that first drop in interest rates leaves us cautiously optimistic for this sector. Next, we're watching medical biotech. It is also depressed by those high interest rates. People pull back on purchasing large equipment, and the pandemic demand has diminished. The medical biotech group, though, has a hopeful outlook as venture capitalist investors are slowly returning. So another hopeful outlook here. And last on this group, we're looking at the ag industry. It has several moving parts. The technology is moving fast. It's incorporating AI into the industry, but it's also being impacted by those high interest rates. Tractor makers are anticipating lower sales still in this group. And right now we're watching if that bird flu hitting the California dairy farms is going to have an impact on this sector. So with all that, 2Q24 came in slightly lower. Again, that energy sector really helped to offset some of those declines we saw in those other groups. We had projected that it would come in about 1.7, came in at about 1.2. So we've slowed down our third and fourth quarter, and in 1Q25 is where we're looking at getting back to our normal growth here. Overall, for the fiscal year, came in at about 2.4% growth. And even with that slowing in the first 2 quarters of next year, we're expecting about 2.2% growth. And finally, onto the restaurant and hotel group. There's several issues impacting this group. Operating costs continue to rise. Restaurants are having to increase their menu prices to keep up with these rising operating costs. They've been taking steps to moderate the menu prices, such as making accommodations for the labor shortage with the rising labor costs they have been experienced the last couple of years. They have modified hours, they have increased automation, they have changed portion sizes, they have scaled down the menu options, but they've still had to raise prices. And we are getting to the point where people are eating out less. The higher menu prices are making for them to opt for alternatives, such as going to the grocery store. To attract customers, restaurants are offering value menus. So almost every restaurant has some sort of value. Those had actually disappeared for a while, and now we're seeing a return of that as restaurants hope that will bring people in, and then they will also buy the more expensive stuff. A majority of restaurant operators still have a positive outlook for future growth in the near term, and Visit California forecasts about a 4% increase in travel spending, which will include increases to restaurants. AB 1228 took effect in this second quarter. It is the minimum wage for fast food restaurants. If a fast food restaurant with more than 60 stores nationally is required to pay $20 an hour of minimum wage, which is $4 higher than the base minimum wage. It took effect April 1st. We already had labor shortages. Restaurants were already pivoting to deal with impacts to their labor costs, and now they are having to raise this minimum wage. The National Restaurant News has preliminarily reported that for the first time in several quarters that California's foot traffic declined more than the national average in this second quarter, as well as California's menu prices rose faster than the national average. So both things that they're starting to compare, saying that AB 1228 is causing some of this shift in California restaurant patterns. Again, it's still really early, and we will have to kind of look at a few more quarters before we can make a conclusion on that. Looking again at menu prices, one of the big things deterring some of their foot traffic. Here, this is from the National Restaurant Association, showing that in 2022 and 2023, yes, menu prices rose 6 to 8%, but look at the red line for grocery store prices. It was rising much faster. Now on the far right, in blue, you see menu prices are still rising 4%. That's nationally. In California, it's closer to 7%, while grocery store prices are down at about 1% growth. This is another indicator of why people would shift down to grocery stores now, where a couple of years ago, when it was still shocking to go out and see how much menu prices have rose, we still kept eating out. And that leads us to our forecast. So even though we have rising menu prices and falling foot traffic, the net result is still positive. It did come in a little bit lower. We had projected about 1.9% for second quarter, and it came in at about 0.7% growth, still positive. Overall for the year, up about 2%. With the slowing in second quarter, though, we did end up slowing down the first couple of quarters of next year. So we've got about 1% growth in third quarter and then up to 2%, leading to overall growth for 24-25 at about 1.7%, and not really getting back to more normal growth until 25-26. And with that, I will hand it back over to Bobby.
Great. Thanks, Susie. Okay, so let's go ahead and kind of wrap up a lot of what we gave you. Hopefully, it was great talking points from Brett and Susie relative to how you look at your local communities and what really makes up the majority or a bigger chunk of your sales tax base. On a fiscal year outlook and how it all comes together. Again, the second quarter ends us here for fiscal year 23-24. I would tell you we had kind of been around this 1% drop number for pretty much the entire fiscal year, kind of fluctuated down 1%, down 1.5% as we continued to watch the economy. So we don't feel like we've been too far off for our expectations and then the actual results for the fiscal year. But as you heard Susie made mention, we did have some higher hopes with what happened in the results that we saw out of 1Q. We try not to be necessarily too optimistic, but we also try not to be too pessimistic, really walking that fine line and trying to hit our number. But I would tell you, as we sat around the table, the 2Q results just being lackluster, not seeing kind of what we had hoped out of both general consumer goods and restaurants. And as Susie made point, AB 1228 and those impacts, what was it going to do to consumers and overall spending, year-over-year spending for restaurant revenue growth? Just didn't see it. And so that has definitely allowed us or kind of made us shift a few things when it comes to our short-term outlook with fiscal year 24-25. The feds and the interest rates and the delay there. Thankfully enough, we've got it now, right? 0.5%. Coming November, we're going to be watching it very closely. Obviously, we know what that'll mean for the next set of data, the third quarter data that we get in December. But now it's here. But what is that doing for basically the first half of fiscal year 24-25? And it's probably not going to meet expectations. And I would then tell you for fiscal year 24-25, we had been a little bit more optimistic, around 1 to 1.5% expected growth. Not off the charts, but we've definitely slowed it down. And this 2Q results, we're trying to be attentive to it, understanding the burdens on consumers overall, and then really thinking about prior year compared to current year. Probably lackluster, expecting something pretty flat as sales tax results go. Hopeful. Definitely, I'm usually more of an optimistic person by nature. Looking outward, fiscal year 24-25 now then expecting as merchants kind of adjust here during fiscal year 25 to consumers and our spending habits, might see some lower prices. Okay, maybe that starts to really kick in for sales tax growth starting in 25-26. You heard Brett talk about autos and kind of where that trend has been most recently. As interest rates come down, we'll expect to see some more normal growth because hey, we all have to get a new car or replace our vehicles at some point in time. Also, building and construction. We know that property values have definitely increased, thereby equity for homeowners, and then the accessibility of it, it's just delayed. So I would tell you, as much as we've looked at, we're still right on track with 25-26 in that 2.5 to 3% growth. As an outlook from there, probably, again, plus 3% as kind of the normal historical growth for California sits. We also, I can't help but acknowledge, come November, we've got a national election. What is that going to do for the economy overall? How are consumers going to feel as we work through that process and to kind of turn the calendar year into 25? Maybe it inspires some growth for consumers, especially here in California. But either way, I think I'm watching what the feds are going to do with interest rates because that'll probably be the first kind of the first tier of inspired growth in the short term. So that's how it all comes together. Again, we're not too far off, haven't adjusted dramatically, but I would tell you the biggest change that we made was here in fiscal year 24-25 because of the 2Q results. So some big takeaways, bullet points. We're always trying to help our clients and thereby attendees really kind of take this information and provide it to others. Interest rate reductions, such a major part of what we're watching in the economy as we sit. Susie went through e-commerce continues to grow. Consumers are spending. It's just a matter of where. Brick and mortar versus online. E-commerce continues to grow. It's nice overall for the for sales tax trends here in California. Question, will lower gas prices, because crude oil has dropped, as you heard Brett may mention, will that help us on the back end of calendar year 24, helping offset some of the other costs within the household? And also pressure from lower prices and deflation. Goods are going to be a little bit more attainable, if you will, not continuing to rise. Is that going to help consumers feel comfortable to keep buying, keeping us where we are, getting ready for the next boost or hopefully growth period that we experience in the short run? As far as our publications go at HDL, stay informed. Go ahead and subscribe to our quarterly emails that we blast out, or actually I think those are monthly, with different economic news and trends that we're watching. We'll go ahead and put those in an email to probably hopefully easier to consume. Coming up, we'll be putting together your newsletter, helping communicate out to your communities about what the trends have been. So a lot more to come as we start in, just getting started on 2Q, even though we've got the results and we're ready for the next quarter as we go. Thank you so much for joining us today. So happy to be able to present to you the most recent sales tax results that we have. Feel free to reach out if you have any questions, you need some more information, anything that may come up. Feel free to reach out to us. We'd be happy to help. Anything else, Brett, Susie? All good? Wonderful.
Hey, Bobby, there was a question just right here at the tail end, going back to cannabis sales. What do you forecast specifically within that group? I would say very flat. We've talked about that industry being saturated and the revenue spread out throughout the state. So we would continue to see that as being pretty flat as we go forward.
Yeah, definitely. I mean, on a statewide basis, down to flat, as Brett may mention, given your specific locality, though, depending on comparative competition, relative competition within your area, if it is overly saturated and your agency has been around for a while, providing cannabis sales, then we may see a bigger decrease given others that maybe just open up. Or if your jurisdiction just opened up, you might have seen an initial boost, but like the longer term trend, eventually it all balances out. And I think that also goes to what Brett just may mention. You probably don't want to build in a lot of growth, leave it flat. And then as we get more and more data, again, if your agency is new to cannabis, kind of wait to see what that trend looks like. It may end up going a little bit more negative just because of saturation, just because of and that saturation for customers and price per unit has been on the decline, and kind of taking all that into account, might want to be conservative on it. Thank you so much, everyone. Have a great rest of your day, and we look forward to meeting with you very soon.